Okay. Anyway, so for you, those of you on this call and those of you who watch it later, it's July, what is it, July 9th and 8th. And want to congratulate all of you as part of the company. In June, we had 71 closings, which is a good number. I think it exceeds our closings last year. And Clear Lake had 21 out of that office and 14 out of Lakeport. So congratulations to our Lake County colleagues. Sonoma had 15 closings, and Santa Rosa 11. So good job by everyone. I don't have the Mingtree numbers quite yet, but they've been very busy up there as well. So congratulations. Couple of things, contract things I'll just cover, and then we'll turn the rest of the meeting over to Nevin, which is the highlight of our training today. But I had a number of calls and inquiries this week on the RLA form that's been amended to include the representative capacity disclosure in the RLA form, just as it is in the RPA form, the purchase agreement. So now if you have a trustee or a power of attorney, LLC, any of those things, the authorized signer would be typed in here, and the printed name of the seller would be the trust, G. Snedeker. But the authorized signer would be me, and title would be trustee, if that's applicable, or power of attorney or whatever it is. That would be all you really need to do. And I would be just signing everything that's G. Snedeker. I don't have to do the trustee of the trust dated blah, 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 like we used to have to do that. So the RCA representative capacity addendum is all built in here on the RLA, just as it is on the purchase agreement now. Okay. Questions came up this week. This keeps coming up. So I'll cover it again because it keeps coming up. They introduced this amendment of existing agreement terms on December 21st. So
we're seeing that.
if you're in an existing purchase agreement or a lease, you would use this form to amend the terms thereof. So you could, closing date shall be 8/1, 22, whatever changes you're going to make, you would use the amendment form and not an addendum. I think it even says it has a place where it presents it as an offer, actually, and then it has a place for with an expiration date, and then has a place for acceptance. So whether it's the seller or the buyer wanting to amend the existing agreement, this is the form you use. And of course, the old standby addendum form, which we always used in the past, is to be used when we're writing the agreement. So if we're writing a purchase agreement or a TDS or anything like that, that has an addendum attached to it at the time we're doing that agreement, we use the addendum. But thereafter, once we're in contract, we use that amendment form. Any questions on that? And finally, this was, haven't heard of this come up for a while, but one of our agents is representing a buyer making an offer, and it is likely to be a short sale. Let's see here. There we go. And so we haven't had many short sales recently, but this particular seller got over leveraged through I think a couple of unfortunate things. I think one was a divorce, and then had to buy the partner out, and there was one other thing. So anyway, they had to borrow a lot of money to kind of settle up things along the way. And now that they're going to sell the property, we're bringing in an offer that's below the asking price. If they could sell at the asking price, apparently they'd come out whole. But the offer, the buyer is not willing to pay the offering price, and no other buyer has either. So we're aware it may be a short sale. So our agent needed to attach the short sale addendum to the RPA. And the short sale addendum, we haven't used this for quite a while. Some of you are new to the business, probably have never seen it before. But the short sale is when the proceeds of the sale are not enough to pay off the loan, and the seller goes to the lender to see if the lender will take less than they're owed in order for to facilitate the sale. So it says that it's contingent upon the seller getting an approved written consent or short sale lender's consent within 45 days is the default. You could put other period of time, 90 days or a certain date certain. And if that doesn't happen, then the deal doesn't happen. So under C here, it says seller shall deliver to buyer a copy of this consent within 3 days after receipt and approval by the seller. And D is if the short sale contingency date the seller is not received. So if by the short sale contingency date, which is this 45 days or whatever date you put up above, the seller has not received the short sale lender's consent, then the buyer has not received that, then the buyer may cancel the agreement in writing. In either case, the buyer shall be entitled to return the deposit. So that's this buyer is tied to this agreement, unlike a backup offer addendum. I'll go into the backup offer addendum real quickly because they're similar in many respects, except in this agreement, the buyer has to stick out this period. They can't kind of call in and say, oh, I found another property during this 45 days and I want to switch to that one. That would be a breach of the agreement. Now, it does allow them to cancel if they find something, discover something about the property that would allow them to cancel under the basic agreement. So if they have an inspection contingency and discover something during this period that would make the property not desirable, and they would cancel under their inspection contingency, they can do that. But they can't cancel just because the seller hasn't provided this thing yet. The time periods are default shall begin. This is the time periods in the agreement for inspections and contingencies and so forth, shall begin the day after the seller delivers to the buyer the lender's consent. Or if you checked here, they shall begin at the specified in the agreement. You don't want to do that because then your buyer would have to go through all their inspections and all without knowing they're going to get the property. So they'd have money down the drain. Same thing applies to the deposit. They don't have to deliver the deposit until the seller delivers. 3 days after the seller delivers the short sale consent. Again, you have a checkbox as specified in the agreement, but why would you put your money in escrow if you don't know what's going to happen? So we just had a basic review of that form, and the basic difference from the backup offer addendum, which some of we haven't really seen a whole lot of backup offers lately, but I like backup offers. Very often they get into first place. So if you're representing a buyer didn't get the first offer accepted, you might consider suggesting they get into a backup position. But anyway, in the backup offer addendum, the same thing applies to the time periods and the deposit. It's number 4 down here. They don't have to start their inspections or put in any deposits or anything until they get notice from the seller that they're in first position. So we're protected that way. And the main difference is that the buyer can cancel this agreement at any time before the seller provides the buyer that they're in first position. So, and it automatically will cancel if you set a date certain by which you want that to happen, and it doesn't happen, then the transaction automatically cancels. So one small difference between those two addendums. So that's all I had come up this week. The other thing I want to remind you of is the CAR course, the 1-hour course they did on the fire hazard disclosure. If you're not kind of fully confident of using that FHDS with your seller, because the seller has to fill out that form, strongly recommend you look at that 1-hour course that's on CAR. And I'll come back to Heather at the end because she's got some reminders about some training. But now I want to recognize and appreciate Nevin for being willing to give us some market tips about how we can be effective with our buyers in this period of this hopefully brief period of higher interest rates. So thank you, Nevin, for taking the time to pull this together.
Welcome. Thank you, Gary and Randy, and all of you for allowing me to spend a few minutes with you all. The genesis of this meeting was a conversation that I had with Randy about a month ago when we talked about the impact and the effect of a loosening market with sellers being more motivated, and how we could use more motivated sellers and creative financing techniques to help our buyers who are impacted by the dramatic rises of interest rates we've had in the last few months. And so thanks, Randy, for putting these ideas in my head, and to Randy and Gary for allowing me to spend a few minutes with you all. So our brief presentation is the 5 things you can do to help buyers in this changing market. And this is, of course, from the perspective of real estate financing. And for those of you that don't know me, I think there's a few of you out there I don't know. My name is Nevin Miller, and I'm the president of Pinnacle Home Loans, your lending partner today. So let's go ahead and get started. Today, it's more important than ever to be educated and informed on the housing market, and especially financing techniques that can help A, your sellers sell homes, and B, get your buyers confident enough to make offers and comfortable enough that they can afford the payments. Gary, everybody can hear me okay? All good? Thank you. Yep. So here's the headlines everybody is seeing. This is a headline from 2 weeks ago. Mortgage rates surged last week as the 30-year fixed rate mortgage moved up more than 0.5 percentage point just that week 2 weeks ago, making the largest 1-week increase in our survey since 1987. And that's the chief economist from Freddie Mac. Everybody knows that interest rates are up sharply, basically in anticipation of the Federal Reserve continuing to raise short-term rates in their attempt to solve the inflation problems in this country. As an aside, we're all pretty unclear on the finance side whether or not raising interest rates can combat inflation, because inflation today is not just that there's too much money in society and people are willing to pay more for things. While there is a lot of money in our circulation right now, at least half the cause of this runaway inflation we're experiencing is the supply chain shortages that were caused by COVID. So we have the Fed trying to fight with the only tool it has, and the markets are very, very nervous that the Fed is going to continue to raise short-term interest rates. And while the Fed has only raised rates 0.75% at the very low levels, mortgage rates are up over 3% in just the last 6 months. So we started the year, January, with fixed rate mortgages at 3.22%. So that's just above all-time lows. We had all-time lows in the summer of last year when mortgage rates were in the mid-2s. But since then, we've seen rates go up fully 2.5% to 3%. And I think that's the largest 6-month move I've ever seen. I remember when I started back in the mortgage industry in the fall of 1991, the Federal Reserve raised interest rates 7 times in 7 months, and mortgage rates went from 7% to 9%, but that was only 2%, not the 3% we've seen today. So this news is all over the place, and all of your buyers and sellers are very aware of this. This is the type of stuff that's in the media today. I don't know who George is, but I thought the quote was appropriate. For buyers of median priced homes, the 1-2 punch of record high prices and rising interest rates has pushed the monthly mortgage payment to about 64% more than last year, tacking on over $800 to the cost of financing. Well, that's not just the rising interest rates that's done that. That's also the fact that home prices have been going up 20% year over year. But there's no question that the rise in interest rates is a big component of that increase in cost of owning a home. Here's one of the most startling things that we can look at to understand how this rise in interest rates affects home buyers. Affordability, as measured by the amount of money that a family has to spend as a function of their total gross income to spend on their mortgage payment to afford a home, has gone from the most affordable in history to the least affordable since 1991 in just 6 months. So this blue line is the affordability index, and the lower the line, the more affordable a home is, all other factors being relative. Here we are in January of 2021, where my cursor is, and affordability was basically right at all-time highs. It was very affordable to buy a home, even though home prices had increased so much because mortgage rates were so low. However, with this recent rise in interest rates that we've seen, we've gone from right here with affordability index under 100 to affordability now being way up in the 130 range. And with the exception of this period in 2005 and 2006, when we had artificial mortgages with 1% start rates, we're now in the least affordable market since all the way back here in 1991. And like it or not, that's the reality that our sellers face as they're trying to attract buyers, and that our buyers have to grapple with as they're trying to figure out how to afford a home. So today's discussion is about showing buyers and sellers how they can use creative financing techniques to make this actually a great time to buy a home. Here, however, are the headlines that everybody is looking at. They're actually really hysterical when you look at them for a second. The first one says the cooling housing market enters into the great deceleration. Oh my God, if that doesn't scream prices are falling, I don't know what it says, but that's not what it says. It says that home prices are decelerating, and the proper way to read that is that home prices are not going to continue to go up as fast as they have, not that they're going down. It's a true headline, but the interpretation of it is what's important. Home prices decelerate. I don't know what those 3 words mean, home prices decelerate, but the headline says the same thing. home prices are not going to continue to go up as fast as they have, but they're going to continue to go up. The best one, by Maury Blackman or Backman of The Motley Fool, says buying a home at the wrong time can backfire big time. Here's why it may pay to wait. That headline is what we have to fight, because it's a fabulous time for a homeowner to buy a home, because home prices are going to continue to increase. Nobody thinks they're not going to. They're just not going to continue to increase at the pace that they have. So let's look at how we can use financing to help buyers and sellers in this market. What's most important is that you refer your clients to a qualified mortgage professional. Let's do a scenario. Let's take $1 million home. Let's put 20% down, and let's look at an $800,000 loan. If we look at an $800,000 loan at 3%, the old payment, January of this year, was $3,372. And the way we qualify a borrower is with their entire principal and interest, taxes, and insurance payment. So their P&I was $3,372. Their taxes were $1,250. I'm going to assume that their insurance is only $250 a month. And to buy $1 million home with 20% down, it took $4,875 a month. And that requires index, a loose calculation, but just ballpark for our presentation today, of around $150,000 a year. Everybody with me so far? However, if we go to 5.75%, that payment, just the principal and interest component, jumped to $4,668. Excuse my typo in there. $1,250 a month in taxes and $250 in insurance makes that payment really $6,168. So they've gone from $4,875 to $6,100. That payment now requires income of over $180,000. And the reality is their qualifying income just increased by at least 23, I think it's 25% because of my little typo. Those numbers are real. And the people who are first-time home buyers who are using FHA funds to get into a home and putting a 3.5% down payment and barely squeaking in at 3% mortgage rates, they're not going to qualify with a 6% rate, plain and simple. Randy told me a good story about a couple of homes that he was selling, one in January and one again in April. And the one in January had lots of first-time buyers. The one in April had none, because you can't qualify if you were barely sneaking in at 3% if rates are now 6%. So the issue is simple. How do we address this? And I've got 4 techniques to show you. Premises before the techniques. First premise is inventory is increasing. It's not increasing super fast, but there's no question that inventory is increasing, in great part motivated by sellers that want to take advantage of all the equity they've built up and sell their home before their perspective that home prices fall. Again, media is telling them that home prices are going to fall. We know, or we believe, that they're not. So first premise is inventories is increasing. Our second premise is sellers are reducing prices and are motivated. And here's where we look at the power of a seller credit. If a seller at $600,000 thought, wow, I'm going to reduce the price to $570. I'm going to do a big fat seller credit of 5% and drop that price to $570. I'm going to argue very convincingly in a moment here that we are all much better to be on the same page of using a seller credit for closing costs than reducing the price of the home. Buyers are motivated, but they're very anxious about interest rates and especially higher payments. It's a great time to buy because there's lots of inventory coming on the market and sellers are motivated. We just have to cross this hurdle of how do we afford to buy right now. Many loan officers and most buyers are very unsophisticated. Any loan agent that's been in the business just since 2010 or 11, they only know 30-year fixed rate notes because that's basically all we've used for the last 10 years. They don't realize the other techniques that we have out there that we're about to talk about. There's lots of ways to skin a cat. These techniques roll around every time we go through a cycle like this, and they absolutely work if you know how to use them. So as we go forward, remember that 3.25% was 33.72, and 5.75%, this is just the principal and interest component, was 46.68. Everybody with me still? So our first technique, instead of dropping that price from 600 down to 582, why don't we tell the seller we want a credit for non-recurring closing costs? Doesn't mean anything to them. If they were going to drop the price from 600 to 582, they'll give us an $18,000 credit, won't they? Let's use 2% of it to pay discount points. And we're all used to not paying points because the mortgage industry recognizes people don't want to pay points. But in this case, if we use 2% of that 3% to pay a 2-point loan fee, and again, we're using the seller's money, so we don't care. And it's benefiting our buyer, so it's all good. And it's helping the seller sell the house, so it's even better. We'll buy that 30-year fixed rate down. Instead of 5.75, the borrower will get 4.75, and they'll get it for the life of the loan. The payment goes from $4,600 to $4,100 and drops just under $500 a month. That will help a huge number of people that found homes unaffordable with a 5.75% interest rate. So again, qualifying income drops substantially. While it's not $3,372, everyone is happy. And taking a 3% credit and using 2% to pay discount points is a lot better than a price reduction to sell this house. Don't we all agree? So if we know somebody's motivated, let's just ask them for a big credit. Doesn't mean any difference to them if they were going to reduce the price. Technique number 2. Remember, 3.25% was 33.72 and 5.75 was 46.68. So this is a technique that unless you've been in the business more than 10 years, you're not going to know. But it's something that has come back in the last 6 months. We offer it. Very few commercial banks offer it because they don't know how to do it. It's mostly the purview of retail mortgage bankers like us. So we're going to do the same thing and ask the seller for a credit. And we're going to get a loan that is called a 2-1 buy down. And a 2-1 buy down is a loan that costs 3 points. But again, we're getting the money from the seller who's motivated and was going to reduce the price. And I'm going to go back to what a 3-2-1 means in a second. And what a 2-1 buy down means is that in the first year of the 30-year fixed rate loan, the payment instead of 5.75 is 3.75, and they get that payment for a whole year. There's no negative amortization. It's still a 30-year fixed rate loan. We just paid up front to drop the payment in the first year all the way down to 3.75. Payment in the second year is 4.75. And the rate from year 3 to year 30 is 5.75. But what this technique does is it makes the payment in the first year plummet all the way down to $3,704. And while the borrowers still have a fixed rate loan, they've got 2 years to realize how to budget for that payment at 5.75. Before the housing crisis of 2008, we used to qualify the buyers on the buy down rate, and we don't get to do that anymore. But the technique of buying down the rate for the first 2 years still works. Let's take one further step. If the loan to value in the transaction that the buyer is doing is less than 80%, we can have a credit for up to 6% from the seller. A 6% credit allows you to do a 3-2-1 buy down, where the interest rate in the first year is 2.75%. So it would be below that $3,372 payment. So using buy downs paying up front to drop the interest rate in either the first 2 or first 3 years can help a borrower who's afraid of those higher payments into a home. And on the other side of the coin, we all know that the backside of rising interest rates is a recession, and the backside of a recession is lower interest rates. The interest rate market is highly cyclical. And while we think rates are up now and are going to stay here for 18 months or 2 years, rates are going to be down again 2 years from now. And if they did a 3-2-1 buy down very conservatively, realistically, they'll probably be able to refinance in a couple of years and get that 3% rate again. So this technique gives them full security, uses the seller's money, and gives them an affordable payment. Technique number 3. Technique number 3 remembers that 3 1/4 was 33.72 and 5 3/4 was 46.68. So we haven't done very many of these in the last few years because fixed rate loans have been so low. But there's a whole class of mortgages called adjustable rate mortgages. And there's 2 different kinds of adjustable rate notes. There are notes that are adjustable from day one, which we discourage people from doing. Most of them have been turned illegal by various Fed bodies because they were dangerous for people. But today's ARMs are either 3, 5, 7, or 10-year fixed rate loans. And following the 3, 5, 7, or 10-year fixed rate period, they turn into an adjustable rate note for the balance of the term. However, the advantage of the 3, 5, or the 7, there's no negative amortization. Principals don't go up. It's a normally amortizing loan. The advantage of it is that, first of all, no one lives in a home today, and I use no one hypothetically. 7 years is a long time, and we know interest rates are going to go down. The 7/1 ARM prices today are around 4%. There is nothing that should scare people about rising interest rates if you can get a 4% note for 7 years. And that payment drops to $3,819. So you can use this technique in combination with technique number 1 or number 2 and get a seller credit for non-recurring closing costs and buy down the interest rate on the 7/1 ARM. You could buy the 7/1 ARM note rate down to 3% and have a lower payment than that $33.72. So you could combine the seller credit with the use of an adjustable rate note to even get them a lower payment and help them into the house. Next one is the most extreme. And last note on technique 3, they'll be out of the home or be able to refi before that 7-year period is up. Technique number 4 is the most extreme of our techniques. And technique number 4 recalls that 3 1/4 was 3,300 and 5 3/4 was 46.68. They can use an ARM, but they can use an ARM where they only pay interest only under the note. And we offer interest only ARMs. Right now we offer them only on jumbo, but they're coming on conventional loans. The borrower only pays the interest owing on the note for the fixed rate period. These notes are extraordinarily popular among high net worth individuals, high income earners, sophisticated borrowers who don't intend to pay off their home, who don't care that they're not paying down principal. They just want to be in the home, have the interest rate deduction, and have the investment. And the interest rate on a 7/1 interest only note, pardon me, the payment on a 7/1 interest only note at 4% is, anybody got an idea? Payment on a 7/1 interest only note is $2,666. Show that to a sophisticated borrower who says, I'm not comfortable buying interest rates, or I can't afford today's payment. And that argument just went away. And if they say, I still don't want to do this, then they're not a serious borrower. So what I've done here today, folks, and I appreciate the opportunity to present to you, is show you that there are sophisticated mortgage instruments, and if explained to a buyer, and if explained properly to a seller and a seller's agent, we can figure out how to come together and get more deals done and help both our sellers and our buyers. You know, before I close, I want to observe that It's often said in our industry, both on your side of the industry and our side of the industry, that the best agents have their best years when it's most challenging. And the reason that the best agents have their best years when it's most challenging is because they don't sit and wait for the phone to ring and say, oh my God, interest rates are up and oh, there's no inventory. They take the techniques that are available to them and go apply them to the market. And so again, with everything that we've presented today, anybody who's a serious buyer can get into the market today. This increase in interest rates that we've had over the last 6 months is temporary. It will reverse. And using one of these 4 techniques or a combination of number 1 and number 2 with number 3 and number 4 can get anybody who's serious about buying a home into a home today. And then the 5th and most important technique of all is it's extremely important that you refer your buyers to the right mortgage professionals. You're not going to get an order taker inside Wells Fargo or Bank of America to understand how to do this, let alone how to explain it to a potential buyer.
Nevin,
Yeah.
this is Kendra. Can you get us like a document or a flyer that might show some of these scenarios? So we can present those to our clients?
Sure, I'll have Deanna. Deanna and I were talking about working this up, and Deanna and I can put together something for you that says, hey, while interest rates at 6% mean your $800,000 loan is this payment, here are ways to make it this payment. And we could absolutely put that together for you, Kendra.
Okay, that'd be great. Also, I've had 2 listings with no showings, none. And it's disheartening. And I think it's because of the news and the interest rates going up.
Yeah. So the best thing that you can do with your buyers is show them that in spite of interest rates going up, it's a tremendous time to be a buyer because sellers are so motivated. And as long as you're buying with a good qualified mortgage technique and you can afford the payment, it's an unbelievable great time to be a buyer.
I'd like to have that document, if you can, for sellers, so I can promote that instead of decreasing the purchase or the amount for the property. We can offer the points.
Yep. And you know what you could do even, Kendra? You could make that part of your listing presentation.
Yeah.
And say, if you list with me, I'm going to show you how you can attract the maximum amount of buyers to your home, because we're going to advertise that our seller credits will go to buy down interest rates for potential buyers. Put that in your listing agreement with your seller. And I think that helped you move somebody over to your side.
Gary, is that okay to put in the comments of the listing in the MLS?
Yeah, actually, we can advertise that. You can put it in our ads. Now, if you're doing that, just check the language of the ad with us before you do it. But yeah, I think you say seller offers credits to buyer for interest rate buy down.
Yeah, maybe Deanna can write up the right language for that.
Yeah.
All right, thank you.
I have a question,
Yeah.
Nevin.
Please.
You said in a slide back, you said a recession is coming, and I'd like to have you talk a little bit about that as to, I mean, you know, all of the news things say it might be coming, it's going to be coming. We don't really know. I'd like your take on that.
Well, I'm not an economist, Mari, but
Okay.
we had every time that there's a yield curve inversion, and that's when short-term interest rates are higher than long-term interest rates. It says the bond market is smarter and is ahead of the Fed. And we had an inverted interest rate last fall. We last had an inverted interest rate curve in 2018. Roger and I talked to everybody who would listen and said a recession is coming, and boy, we had one. And pretty much any economist you talk to right now says that the only way that the Fed can slow down inflation is dramatically raise interest rates. And the backside of literally every historic period of rising interest rates has been a recession. The Fed always tries to engineer what they call a quote soft landing, where they raise rates just enough to slow down the economy without putting it in recession. But I don't think they've ever engineered a soft landing. The backside of any period of rising interest rates is almost always a recession, and everybody thinks we're going to have one.
Okay, I was hearing things even this morning about the part of the big problem is the supply chain and what that's doing to everything, prices. I don't know.
So that's the conundrum of all this, Maury, and I started by identifying that. This is just not a money supply inflation. This is an inflation caused by a shortage of goods and services as much as a money supply issue.
Okay.
And that gives me bigger concerns because it says the Fed might try to be so aggressive with the only tool they have, raising short-term interest rates, when that's not an effective tool to solve a supply chain problem.
Right.
So that's what everybody's really worried about, that thinks about this, is that the Fed only has this one tool, but they can't fix the supply chain problems. And so they're going to have to push interest rates up. The further they go in their attempt to solve this problem, the worse it's going to be for the likelihood of a recession, and the less they do to solve the supply chain problem, because that's not in their purview.
Yeah. Yeah.
It's a unique set of circumstances. There's no doubt about it.
Yeah. Well, thank you. I was interested in your insights. Thanks.
Welcome.
And who are these folks on the screen there? Here they are.
Oh, sorry. That's Hannah, who services the Petaluma office. There's Steve in the middle of our screen, Ted and Amanda, who are Sebastopol and Santa Rosa, and your dear Deanna in Sonoma.
Great. Thanks so much. Okay. There was a request that maybe if you could provide those 4 technique slides, the completed ones, that in some form that we might be able to use. That would be great.
I'll have Priscilla pull those out of this presentation, Gary, and send them to you and to Randy.
Great. I noticed Randy was on the call. Randy, you have anything to add here?
He stepped away from his office, I can see. He's not in there.
Okay, very good. Well, thanks, Nevin. That was very instructive, and I think very, very clear, and gives us some real good tools to work with.
Yeah. Okay. Thanks, everybody. Appreciate the opportunity to be with you all today.
Great. Thanks. Safe trip back.
Okay.
Heather, you want to announce what you have?
Yes, absolutely. And also thank you so much, Nevin. I love those strategies, those different options. I think it's really great. The more we get them in our mind, the more we're going to be able to explain well to our clients and utilize those techniques. So that's awesome. Gary, can I share my screen?
Yeah, I made you a co-host, but
Okay.
I think Nevin or Priscilla need to back off their screen. So
Okay, perfect. Thank you so much. First off, just really quick, next week we'll be starting the foundations training again, which is 6 weeks long. And it's really going through kind of A to Z, everything about your real estate business. Next week, it will be starting, it's really great for new agents, or if you just kind of want to reset your business and, make a plan and really get after things. It's a great thing to do. Next week, we'll be looking at all different streams of business, ways that you can create business, and, choosing a path for yourself and how you're going to get out there in the community. It'll be from 12 to 1:30 on Mondays for 6 weeks. And this time I'm going to do it all virtual. We'll go back to in person next time, but I want to do it all virtual, get a really nice recording so that it's on the YouTube. You guys can easily watch it at any time as well. And then the other thing I wanted to point out to you is that I have, let's see, there we go. We now have a, can you guys see this Outlook calendar?
yes. Mm-hmm.
Okay, great. We now have in your, you have access to this Outlook calendar. So in here are all of our training dates. You can see, like, here's today's training, and the Zoom link is right in there. So all the trainings are going to be on this. I sent out an email with a link to add it to your own Outlook account. I do also have it in Google. If anybody, didn't seem like many people were using Google, but if you want that, let me know as well. But this is great, right where you're getting your emails and everything. You can have this Outlook calendar. It has all of our in-house trainings, all of our virtual trainings. I also have put up the different office meetings are on here. So anything Better Homes and Gardens, Wine Country Group, I will have on this calendar. So it's a one-stop shop place that you can go and find, what you're looking for. I am also putting the events that are coming up in Greenhouse. So for instance, here is the Thrive course. That's a one-day course. You do have to go into Greenhouse to register for those. So there's not a direct link with a Zoom link. Any of the Greenhouse courses, you have to go into Greenhouse to register for. And then the other thing I wanted to point out is, did I not put it on here? I think I had it on here. Where is it? Maybe it's next Tuesday. Either next Monday or Tuesday, Greenhouse is offering a 4-week listing challenge where you come in once or twice a week and it helps you, really build your listing business, doing lots of follow through and things. So I encourage you to check that out. I don't know why I don't see it in here. I think it's, why don't I see it? Anywho, I will send out a reminder about that as well. It is coming up either, I think it's next. Oh, I'm a day off. There we go. It is. Here it is, the 21-day listing challenge. It is Mondays and Thursdays from 9 to 9:30. It's just a quick little half hour to keep you really motivated and going and increasing your listings. So take a look at that. It starts on Monday and it's those 8 sessions. So otherwise, let me know if you have any questions and upload this calendar into your Outlook so you can easily access all of the trainings anytime.
Great job on the calendar there. Really appreciate that. Let's see. Kendra had a good doubling back to the contract forms and the amendment form versus the addendum form. There was a question that, let's see, why couldn't we use the extension form if we're just extending something? So here's the extension of time addendum. You can see this has not been changed since April of 2006. So that's an old form, and it's pretty straightforward. You fill out these things here, and you get everybody to sign. The reason that this amendment form was introduced is that we found when we used that extension form or that addendum form and just let's say the buyer wants to submit a change, the new closing date, and they use the addendum form and they sign it, well, it's essentially an offer to the seller. And if the seller refuses, it would be similar to a counter offer. So let's say the buyer's made an offer, the seller counter offer, and the buyer wants to make another counter offer, and they do. But if the seller doesn't accept that counter offer, then all of the offers falling apart. There's no contract. And essentially, there were claims there were instances where sellers would do that. They would get an addendum form like that. They would refuse to sign it and they would cancel the transaction. And that's why this amendment form was made up with these terms in here that are similar to a counteroffer, that this offer has an expiration, that if the seller doesn't sign it, the buyer can still proceed. They're still in contract. They just haven't gotten what they wanted in terms of the extension or whatever it is they're asking for. So the risk of a seller or of one party bailing out is taken away when you use this amendment form as opposed to an addendum form. So I hope that's clear. That's why this form was introduced. And doubling back on what Nevin was presenting there, we get into kind of patterns, of what do we do to sell our listing? We get a price reduction. I used to have an agent who said that all properties will sell at the right price, but we are in a market where maybe the price reduction isn't the most effective thing to do for the buyer. So one of our more experienced agents was going to reduce the, talking about a price reduction with their seller. And we said, it was like a large, it's listed at $1.5 million. We're going to take a 10%, $150,000 price reduction, $1.35 million. And I said, well, you should consider maybe seeing if the seller will give a credit, to the buyer for, part of that, at least half of it, given to the credit as a closing cost, because then there could be a buy down and more people could afford the property. But, old habits change slowly. And the agent went ahead with the price reduction, and now, they don't have the chance for the buy down. So, keep these things in mind for both your buyers and your sellers. There's a question, can we use these 5 techniques in our CRM? Certainly we can use them wherever we feel they'll be effective. Nevin said that these are good to work with when you're listing presentations or your CRM. So certainly attach these, and many agents don't get this background and this information. So it sets us apart for being a little more knowledgeable in how we can use the mortgage market to our advantage, both for the sellers and the buyers. So we'll continue to look at these things and come back and cover them again as they evolve. And Deanna and Nevin are going to work up some flyers that we can use in both our CRMs. And if you have a specific listing, remember when we used to have flyers at our property that showed what the different mortgage options were? We'll do those flyers too. Okay. So any questions out of all that? Well, if not, we'll look forward to seeing you next week. Thanks for tuning in. And hope you got some value out of that work that Nevin did for us. Thanks a bunch. Bye, Heather. Drive safely.
Everybody, have a good one.
Bye-bye. Have a good weekend.